Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest GDP data coming out for the second quarter of 2025. We knew it was going to be bad. We didn't expect it to be quite this bad. I think we had penciled in the market was expecting more around a 0.5% hit to GDP in the second quarter. It came in at negative 0.9, a whole lot worse than expected, below the Reserve Bank's expectations of down 0.3. But this was a fundamentally fairly consequential bad result coming forward. And I guess the risk and the challenge is that, again, although we expected a hit and we were hoping to see a bit of a resumption and better economic trends out the other side, we just haven't really got any evidence that the economy is going to lift itself out of what seems like a pretty tough hole. I mean, economic activity in the 3 months to June 2025 was, 1.1% smaller as an economy than where we had things going back a year. That's a pretty tough blow. What were the sort of breakdowns that led to that particularly poor, particularly downbeat result?
Yeah, a couple of aspects of the numbers jumped out to me. Firstly, was the contraction in investment activity through the private sector. We know areas like construction, for example, have been under plenty of pressure and dominating the headlines over recent quarters, so not too much of a surprise in terms of that aspect of the numbers. But where we had seen a bit more positivity coming through in the previous couple of quarters around investment in plant and machinery and equipment, for example, that fell back again in the June quarter. So that was quite a significant negative contributor to what we saw in the latest 3 months. The other one that jumped out at me was in terms of export volumes, and again they were softer, and we were seeing that across some aspects of the agricultural side of things. Meat, again, not unexpected in terms of what meat has been doing. We know that slaughtering volumes are running down about 7% from where they were over the last 12 months. So there has been pressure coming through there. Dairy, a little more surprising in terms of a bit of sort of a weakness coming through in dairy exports. Yet we know, of course, that dairy production has been growing slightly. So a little bit strange there. But you take those two aspects together, right? The business investment and weakness, the weakness in exports, and you can sheet both of those home to some degree, at least, to the international environment, right? And the uncertainty, particularly, that has been engendered through the June quarter by Liberation Day, the tariffs from Trump, and the sort of fallout over subsequent weeks from that. Now, we've seen through more recent months that the financial markets internationally have kind of shaken that off and gone, oh, it's maybe not going to be as bad as we thought. We've seen forecasts for international growth and North American growth being revised up slightly, and they're not as good as they were at the start of the year, but they're better than they were back in April and May. So there has been a little more positive news coming through more recently, but the real hit we have seen, particularly from a New Zealand point of view, coming through in that June quarter. And there's not, I guess, a great deal of evidence that we're bouncing back ourselves as an economy particularly quickly from that. You know, there's still aspects in terms of more recent economic indicators where you'd look at them around manufacturing activity, around the labour market and go, yeah, there's not massive signs of improvement yet. So, yeah, quite a difficult result to digest. As you say, much worse than had been anticipated. And, not a lot of good news through the numbers at all, really, when you look through them.
No, they were incredibly tough. I still think it's worthwhile dwelling on a few of or one of the positives in a sense, and that was household spending that did actually increase. I think was at 0.4% in the quarter, so a bit of a lift, not massive, but I think also that's why, in my mind, looking through, you're right that part of the uncertainty that businesses were grappling with really did come through in those investment figures. You know, people went, look, I can't make a commitment. I don't know what these tariffs are going to do. I'm going to go and sit on my hands for a period. You saw that coming through in the manufacturing figures, not only in GDP, but even before that in the PMIs that were emerging and showing that, you know, you were seeing an expansion in manufacturing up until sort of April, May, then it pulled back for a couple of months. And I guess with all of that, it's interesting that a lot of the business surveys continue to show businesses that apparently want to and are thinking about investing, but the actual reality is they're not. And I think that sort of divide is one of the challenges that we're trying to grapple with of, do we look at what business are saying they're going to do or what they're actually doing? Because at the moment it has been weaker. I'd make the point that, and I think, look, this is a little bit difficult because GDP, there are so many moving parts. We know that there can be some pretty big revisions coming through. And I guess there's just a level of caution that because this hit and decline was so much bigger than what we first expected, we've got two big rounds of re-estimation and potential sort of revisions that might come through to these figures. In December 2025, you'll get a revision for all of the numbers so far that'll more heavily influence the last 2 years. It'll give us a clearer read on parts of calendar year 24 and then a little bit on what we've seen so far in 25. But then even a year after that, you'll get sort of more settled annual figures for the 2025 year. So I'm not saying that I think that's going to magically reverse it all away, but I also wouldn't be surprised if you saw a revision in a couple of years' time that saw that the hit to activity might have been a little bit more in line to what we saw from actual indicators in terms of the PMIs and similar, because we were all shocked. It's not like there were a bunch of economists out there going, yes, we're on a much harder hit view, and there are others of us that were sort of sitting there thinking it was going to be more softly. No one expected just how bad that figure was. Now, the finance minister, I feel, and the government in general have copped a fair bit in recent times. There's been all sorts of calls for resignation and similar. I think part of that's because the government went so strong on the going for growth this year, and it's sort of hard to continue with that phrase when you had 0.9% up at the start of the year. That was a good start, and then it's all sort of been reversed out in the second quarter. Politicians, in my mind, are always going to struggle when they claim some economic numbers, like lower inflation. They then sort of have to claim them all. And realistically, government's just not all that influential. Yes, they've got an influence, but they're not dictating every single bit of economic activity. I want to just turn though to what's going to happen, what it means sort of for the rest of the economy. We've seen, some calls from banks. We ourselves are starting to move into a position where you go, it was that big, it was that bad. The economy clearly isn't getting that momentum up nearly as quickly as expected. There seems to be an element of a crisis of confidence, even though the actual confidence figures seem more upbeat. At what point do you think this moves the Reserve Bank to need to do more and do more quicker?
Yeah, the Reserve Bank's last couple of statements, they have talked fairly heavily, or put the emphasis fairly heavily on spare capacity in the economy, on the fact that we're not growing at potential output, and there's a whole lot of sort of spare labour, spare capital out there that could be better utilised. If this 0.9% figure is correct, and look, that's what the Reserve Bank has to work with at the moment, then there is even more spare capacity than had been previously anticipated. And so it does really, for me, open the door to a larger cut at their next review coming up in a couple of weeks' time in October. So they'd previously signalled they'd probably cut by another 50 basis points through the rest of this year, taking the OCR down to 2.5%. Looks like the balance of probability says that'll all come in one hit in October, because there's no other big pieces of data before then. And so I think this does really sort of crystallise the need for more cuts. And bearing in mind, I think that at the most recent review, there was discussion about a potential 50-point cut at that point in time. So they've already been leaning in that direction anyway. Beyond that, you come through to November. I suspect if you're cutting, whether you're cutting 50 or not in October, there'll be another cut in November as well. Again, what are the big pieces of data you're going to get before then? A CPI, of course, which suggestions that could be pushing up to 3%, but that's already expected, right? And the labour market as well. The labour market not really showing any signs of turning around. Yes, job ads have pushed up twice in the last 2 months. It's the first time since 2022. It's the smallest skerritt of good news, but there's not enough there that's going to turn, the unemployment rate around and start to see a massive sort of shift in that labour market yet. So I think, you take all of that together, there's probably another cut in November. February's a long way off, and I'm not going to commit to that, but it could well be that we get an OCR down towards 2% in early 2026 if things aren't turning around. So, yeah, there's enough in this data for the Reserve Bank to have to react more quickly, even bearing in mind some of those risks you've talked about maybe the numbers when they're revised in the future are not as bad as we're seeing today. The bank has to act on what they're seeing at the moment, the information that they've got, and, at the risk of overstimulating the economy and getting a bit more momentum into growth out to 2026 and 2027. Well, I think at the moment, given the way the economy has been performing, probably the Reserve Bank would take that, and I certainly suggest that the politicians would be taking that as well, given how strongly they've been pushing that economic growth story.
And look, market pricing's on board with that. There's a 66% chance of a 50 basis point cut in October, and I think that highlights that sort of shift quite quickly to needing to do more quicker. And although, look, I can certainly understand the Reserve Bank, making a call like that based on the data we've got and their expectations, I do still think, just in the back of my mind, you're in this really uncomfortable position where economic activity is not going nearly like you'd be wanting it to. The labour market is still in a fairly loose position. You've got a lot of spare capacity there. But headline inflation is still higher than anyone would like. You're still hearing some pretty big concerns from households around some of that. Yep, you can explain a lot of it, but still an uncomfortable position to be having to more drastically, much quicker cut interest rates at a time when you've still got some of that latent pricing pressure around, a bit more concentrated, absolutely, but geez, it just makes the conversation difficult. What do you say out to people? You're cutting because the GDP's down and the labour market and the unemployment rate's up, but sort of inflation, the thing that you have to control, is still under pressure. It still, I think, raises the risks that at some point within the next sort of 12 to 18 months afterwards, you might have overdone it because of that sort of need to try and recalibrate the economy. You're going for a number of unders and overs to try and find the right position. We'll continue to assess all of that, what the Reserve Bank does, how the government reacts, and what other economic data comes through, and what it tells us about the future of the economy on one of our future editions of Econ Talks.